207,000, which is a drop of 8,000 on initial claims. Of course, that's 215,000 is 1,000 more than was originally released last Thursday. If we look at factory orders for the month of August, factory orders are not out yet. Sorry, we're looking for some of the other, nope, not out on any of the services yet. As a matter of fact, it's a weird morning altogether because even continuing claims hasn't got matched up on any of our services with continuing claims yet. So it seems as though the data is, oh, here we go. Continuing claims moved from 1.663 million to 1.65 million. Gosh, these are really, really low numbers with respect to continuing claims. They're always a week in arrears. I believe those are the week ending the 22nd. But I don't see any of the data yet, Becky. But I do see a 319 10-year. It's kind of interesting. 10s minus 2s. We were all very nervous when it was hovering, in that 20-ish neighborhood. It's now over 30. Trading at 32. And the only reason I mention it is I think that a steepening yield curve is probably best for the Fed to complete its mission without disturbing markets too much as it continues to try to snug up rates for a little insurance and against the next recession, maybe inflation out there. I'll throw it back to you.
Rick, let me ask you a question. Let me ask you a question just about yields. Why do you think we saw such a big move yesterday? What was it that the market was digesting or hearing or suddenly kind of keying on?
Well, I think the big move yesterday in many ways was technical, but the technical floodgates opened for a very specific reason. I think it's now post some of the issues regarding the tariffs, at least with regard to North America. This ever-growing notion now that we sort of have Europe in our camp that China eventually is going to happen most likely after the midterms. But yeah, I think the data, and I also think that the idea of what stock market activity is doing, what some of the economy and the metrics yesterday, especially for the service sector of the economy, are all very valid reasons for our rates to shoot up. I think the most important question at this point to monitor is how overseas rates end up responding and the yield curve. Bund yields were up at 52, but last Tuesday they closed at 54. So to me, the idea of what Japanese and European rates do is going to be critical. The dollar's gotten a bit expensive based on how the rate structure and the interest rate differentials have broken down. So that should keep the dollar index from rising too quickly. And I do apologize that that is a 10 o'clock factory orders number I was looking for. So we will cover it eventually. But I really do think that paying attention to the long end for any of you investors out there is critical. There's been a lot of false moves. This one in interest rates certainly isn't, at least in my opinion.